The information provided in this video is for general informational and educational purposes only. It is not intended as professional financial or investment advice. Always seek the advice of a qualified financial advisor with any questions you may have regarding your personal financial situation or investment decisions. The creator is not liable for any errors or omissions, or for any losses or damages you may incur as a result of relying on this content. Past performance is not an indicator of future results. Do your own research.
Welcome back to Iron Financial. Today, we are dissecting the single most important company in the global economy, Taiwan's semiconductor manufacturing company, better known as TSMC. If you are listening to this in early 2026, you already know that the AI supercycle is not just a buzzword anymore. It is the hardware reality that powers our world. And at the center of that reality sits one foundry. While companies like Nvidia, Apple, and AMD get the headlines for their designs, they are effectively what we call fabless architects. They draw the blueprints, but TSMC builds the skyscrapers. As we enter 2026, their monopoly on advanced logic chips has shifted from being just a market advantage to a geopolitical necessity. Unlike its integrated competitors, specifically Intel, which designs and manufactures its own chips, TSMC operates purely as a foundry. They do not compete with their customers, they enable them. This neutral status is their greatest asset. In this video, we are going to look under the hood of TSM stock. We will break down their financials compared to struggling rivals like Intel and Samsung, and we will analyze the just-released numbers on their 2nm process. We will also run through 3 valuation models, including a discounted cash flow and a comparable company analysis, to see if the stock is still a buy after its massive run-up in 2025. Whether you are a growth investor chasing the AI wave or a value investor worried about the geopolitical risk premium, this analysis covers it all. Let's get into the numbers. The biggest story right now is technology leadership. Just days ago, on December 31, 2025, TSMC officially commenced mass production of its 2nm process nodes, also known as N2. This is a critical milestone. While Intel has been aggressively marketing its 18A process to regain the lead, TSMC's N2 is reportedly seeing higher initial yields and better power efficiency. This effectively locks in customers like Apple and Nvidia for the next generation of iPhone and Blackwell AI chips, leaving Samsung's foundry business trailing further behind in third place. Financially, the massive revenue doubling from artificial intelligence that we were promised back in 2024 has finally materialized. Throughout 2025, we saw AI-related chip revenue surge, now accounting for a substantial chunk of their total top line. The packaging bottleneck, known as CoWoS, or chip on wafer on substrate, that plagued the industry in 2024 has largely been resolved. TSMC aggressively expanded capacity, hitting roughly 130,000 wafers per month by the end of 2025. This is a massive jump that has unlocked pent-up demand for AI accelerators. On the geopolitical front, the diversification strategy is live. The Arizona fabs are operational, albeit with the well-publicized delays and cultural friction we saw last year. However, the narrative has shifted from delays to strategic redundancy. With the U.S. election cycle behind us and new trade policies taking shape for 2026, the ability to manufacture on American soil is becoming a premium service that customers are willing to pay extra for, protecting margins despite the higher overseas operating costs.
Let's look at the scorecard. The financials here are remarkably robust, especially when compared to the capital-intensive nature of this industry. First, let's look at margins. TSMC is currently boasting a gross margin between 57 and 59%. To put that in perspective, Intel, which was historically the margin king, has struggled to keep its gross margins above 40% as it burns cash on its foundry build-out. TSMC's operating margin is hovering near 48%, a staggering figure that demonstrates their pricing power. They are the only game in town for 3nm and 2nm chips, so they dictate the price. Next is return on equity, or ROE. The company consistently delivers an ROE of roughly 25 to 30%. This is significantly higher than Samsung Electronics, which is dragged down by its cyclical memory business and lower-yield foundry operations. Regarding valuation metrics, as we sit here in January 2026, the stock trades at a forward PE ratio of approximately 25 times earnings. While this is higher than its historical average of 18 times, it is cheap compared to the broader semiconductor ecosystem. More importantly, the PEG ratio, which measures price to earnings relative to growth, is sitting around 1.0 to 1.1. A PEG near 1 typically signals a fairly valued stock relative to its growth. Their balance sheet remains pristine. The debt-to-equity ratio is typically under 0.3. Unlike Intel, which has taken on significant leverage to fund its strategy, TSMC funds its massive capital expenditures largely through its own operating cash flow. While free cash flow generation has been a concern due to spending over $30 billion annually on factories, cash flow conversion has improved significantly entering 2026 now that the 3-nanometer node is fully ramped up.
Valuing TSMC is tricky because it has no direct peer, but we can triangulate a fair value using 3 distinct methods. First, we have the comparable company analysis. If we compare TSMC to other foundries like Global Foundries, TSMC trades at a massive premium. However, those aren't real competitors. A better comparison is the pick and shovel equipment makers like ASML or Applied Materials. TSMC trades at a discount to these firms, which often trade at 30 to 40 times earnings. Given their monopoly utility, an argument can be made that the stock should trade closer to 30 times earnings. If we apply a 28 times multiple to projected 2026 earnings per share, we see significant upside from current levels. Second is the discounted cash flow, or DCF model. This tells a different story. If we assume a discount rate, or WACC, of 10% to add a premium for geopolitical risk, and a terminal growth rate of 3%, the stock currently looks slightly overvalued by roughly 15 to 20%. The market is pricing in perfection. Specifically, that AI growth will continue at 40 to 50% compounded annually for another 5 years. If AI demand cools even slightly, the DCF value drops significantly to around $200 per share. Third is the dividend discount model. TSMC is a reliable dividend payer, unlike many tech growth stocks. They have steadily increased payouts. However, as a capital-intensive growth company, they reinvest most earnings back into the business. A dividend model yields a much lower valuation because it ignores the massive retained earnings used for growth. This model is less useful here, but it provides a floor for the stock price. Investors know there is a tangible cash return waiting for them, which limits downside risk during market corrections. Numbers only tell half the story. The moat around TSMC is arguably the widest in history. First is the ecosystem lock-in. It is not just about having the best machines from ASML, it is about the intellectual property ecosystem. TSMC has the Grand Alliance, a library of intellectual property from partners like ARM, Cadence, and Synopsys that is optimized specifically for TSMC silicon. If a company like Apple wanted to switch to Intel Foundry, they wouldn't just need to move factories, they would have to redesign their chips from the ground up. The switching costs are astronomical. Second, we cannot ignore the elephant in the room, the silicon shield. The China risk is the primary reason the stock trades at a PE of 25 instead of 40. The qualitative argument is that the world, including the US and its allies, cannot afford for TSMC to go offline. This creates a paradoxical safety net. The company is so vital that it is protected by global superpowers. However, this also introduces binary risk. If a blockade or conflict occurs, the stock value goes to zero. This is an unquantifiable risk that every investor must accept. Finally, there is the talent culture. Their engineers are known for a grueling work ethic that is difficult to replicate in Arizona or Germany. This PhD factory in Taiwan is their secret weapon for yield dominance. While competitors struggle to get yields over 60%, TSMC consistently hits 80 to 90% faster than anyone else, ensuring client satisfaction and higher margins. TSMC is known for wafers, but their smaller bets are becoming massive revenue streams. The most important is advanced packaging. For years, packaging was an afterthought, it was a low-margin, boring end to the process. TSMC flipped this. They realized that Moore's law was slowing down, and you could not just make transistors smaller forever. So, they bet on advanced packaging, which involves stacking chips vertically and horizontally to increase power. This bet paid off when AI demanded it. Their CoWoS technology is now the bottleneck for the entire AI industry. While it is a small bet relative to total revenue, approaching 10%, it is the gatekeeper for their highest margin clients. Looking further out, they are betting on silicon photonics. As data centers grow, moving data via copper wires is becoming too slow and too hot. TSMC is developing technology to integrate optical, or light-based, data transfer directly onto the chip. This is currently a niche R&D project, but by 2028, it could be the standard for AI data centers, giving TSMC yet another monopoly layer on top of the silicon itself. They also maintain a legacy business in microcontrollers and sensors, specifically 28nm and older nodes. While not sexy, these fabs are fully depreciated, meaning they print pure profit. This long tail of older tech funds the R&D for the bleeding-edge bets. To wrap this up, let's look at the bull versus the bear. The bear case is simple: cyclicality and geopolitics. Bears argue that the AI supercycle will eventually hit a digestion phase where Microsoft and Google stop buying chips to focus on software profitability. If chip demand drops, TSMC is left with massive, expensive factories sitting idle with high fixed costs. Combined with the constant threat of cross-strait tensions with China, bears see a stock that is priced for perfection in a world that is far from perfect. The bull case is that we are in the early innings of a defined decade-long shift in computing. Bulls believe TSMC is not just a chip maker, but the oil refinery of the digital age. With Intel stumbling on its rollout and Samsung unable to fix yield issues, TSMC effectively has pricing power monopoly. They can raise prices 10% a year, and customers have to pay it. Bulls see the PE of 25 as a steal for a monopoly growing earnings at 20% or more annually. In summary, TSMC is a company executing at an elite level. The pros are a technological monopoly on 2nm chips, massive margins of 58%, and a reasonable valuation with a PEG ratio near 1.1. The cons are undeniable geopolitical risk and capital intensity. If you believe AI is the future, TSMC is the safest way to play it, provided you can stomach the geopolitical headline risk. This isn't a stock for the faint of heart, but for the iron financial portfolio, it remains a core watchlist contender.
That wraps up our deep dive into the most critical company in the silicon supply chain. If you found value in this analysis, do me a favor and hit that like button. It tells the algorithm that detailed financial breakdowns matter more than hype. I want to hear from you in the comments. Are you buying TSMC at these levels, or is the geopolitical risk keeping you on the sidelines? Let me know your price target. If you are new here, subscribe and ring the bell so you don't miss our next breakdown. We are looking at covering ASML or AMD next. Vote for which one you want to see in the comments below. This has been Iron Financial. Stay analytical, stay disciplined, and I will see you in the next one.